It is a beautiful 80-degree day here in Florida, and from the looks of it, everything looks normal. But what is happening around the world is affecting people and stock markets all over. Now, I filmed this video earlier in the day, but I'm making the narration at night after Trump announced flights to Europe are banned, and now the Dow futures are down over 1,000 points, and oil futures are down another 5%. In Italy, 2 days ago, they announced a quarantine of the whole country. People were not allowed to enter or leave their cities, but bars and restaurants can be open until 6 p.m. Now, 2 days later, they announced that all stores must close except banks, the post office, supermarkets, pharmacies, and tobacco shops that sell cigarettes and lottery tickets, of all things. You can't get your car fixed or anything like that. Everything else is closed. Now, just think the effect this is going to have on the economy from shutting in 60 million people in Italy. Now, think what happens if that happens to more countries, including the US. The shock to the economy and the chain reaction of people losing their jobs, not being able to pay their rent or mortgage or car payments or food. Before the virus, most Americans could not come up with $1,000 in emergency. Something like more than 50% could not come up with that kind of money in emergency. Now, if people stay quarantined for more than a few weeks, many large and small companies will be severely financially stressed and may even go bankrupt. This includes big banks as well, because they're the end lenders to all of these businesses that need money to keep their doors opened. So what does this mean for the stock market, price levels, and PE ratios? We've been in a bull market for 11 years, and many investors only have seen the stock market continually go up. The kind of market we were in was one where even bad news in an earnings report was seen as good news and made the stock soon go higher. That's what happens in a bull market. In a neutral market, good news makes stocks go up, bad news makes stocks go down. In a bear market, stocks go down even on good news and go down even further on bad news. This looks to be the type of market we are heading into. In previous bear markets and recessions like 2009 and 2000, people did not expect life as we know it to change much. Some people lost their jobs, some people lost their house, or some of their savings in the stock market, but the future was relatively known and predictable, and they all assume that this too shall pass and things will get better. Now, whether you think the coronavirus is just the flu or the second coming of the plague or something in between is kind of irrelevant. The effect of the measures being taken to combat it are certain. Economic growth will slow a lot, and maybe more than we have ever seen, and companies' earnings will fall, and forward guidance will be bad and very unpredictable. Now, during this bull market, people have gotten so optimistic that they have bid up the S&P 500 to a PE ratio of about 25 just a few months ago. The PE ratio is the price to earnings ratio, or basically a measure of how much you are willing to pay for a stock for every $1 of earnings per year per share. So if the PE is 10, you're paying $10 for $1 a year in earnings, or a 10% return. If the PE is 20, you are getting 5% per year return. Historically, the PE of the S&P is about 15 to 18. So now, if you are an investor who was fine to overpay for the S&P 500 at a PE of 25 because everything was going good a few months ago in the economy and earnings were growing steadily and predictably, what PE is that same investor willing to pay going forward when they know earnings will drop for sure and they have no idea of how bad they will be going forward? Are you going to be gung-ho and pay a 25 PE, or are you going to be super cautious and wait to pay closer to 15 until you can see that there's some light at the end of the tunnel? Of course, you're going to want to pay less. So if a stock has a PE of 25 and makes $1 per share in earnings, that stock will be $25 a share. Now, if the earnings stay the same, but people are only willing to pay a 15 PE, that stock will be sold down until it is $15 a share. But what if the earnings also drop to 50 cents a share and people are only willing to invest at a 15 PE? Well, that stock will now be $7.50 a share, or a 70% drop from $25. Now, I don't know that many stocks will have their earnings drop 50%, but some sure will, like oil companies, airlines, hotels, etc. And this PE contraction happens on the way down in a market, just like how PE expansion happens on the way up. Now, I'm talking here about the S&P 500, which is a broad range of the biggest companies in the US. Now, think about these FANG type stocks or other high flyers that already have sky-high PEs or actually have no earnings, something like a company like Tesla. They are in even bigger danger because when the market really starts crashing, people get conservative and sell the most speculative stuff first. And if you think this sell-off is big, look at a chart. We're just only now 20% off the highs, so we are officially in a bear market. Yet, we are not even below the last sell-off at the end of 2018. So if you have never seen a bear market in your investing career and all you keep hearing is buy the dip, dollar cost average, and stocks always come back in the long run, you may need to reevaluate. The dot-com bubble in 2000 did not recover to new highs until about 13 years later. The uncertainty going forward is going to be very fast changing, so you might want to consider getting out of the way until companies have a clear idea of how their earnings will be going forward, or at least wait until the PE of the market, being the S&P or the Dow, is on the low end of its historical range, closer to 15. You don't want to wait until earnings season and see how bad it really is, because by then it's going to be too late. Many people think they will buy at the bottom when the market crashes, but I will tell you from experience, it is very hard to buy at the bottom when you are holding on to stocks with huge losses all the way down. What usually happens is that people hold on and ride their stocks down until the financial loss is too much and they just have to sell. This, unfortunately, is usually the bottom, but you have very little money and no confidence left to buy. If you like this video, give me a thumbs up and leave a comment if you think the market is going to fall much more, or if you think this fear is overblown and the market will rally back to new highs soon. If you haven't done so, please subscribe to my channel. Thanks for watching.